Hello guys, myself Kalpesh Vitlani. By profession I am a chartered accountant. So welcome all to the Master the Market, and today we are going to cover the topic Master the Options Level 1. So this presentation is basically on the basics of options plus one of the strategies which we teach in our program Master the Options Simplified. Okay, so in the beginning, I would like to tell you one story. Like in options, there are two things: either you can buy the options or you can sell the options. So, in the beginning only, I want to tell you that the option writers are like crocodiles. So, if you want to buy the options, you have to be learning the skill to fight with the crocodile and to earn the money, and the money out of the mouth of the crocodile, or you can become the crocodile. So you have two choices: either to buy the options, so learn the technique to pull the money out of option sellers, or you become the writer. One more thing I can tell you is options writing is like insurance company. You might have heard about the insurance companies. This is a very simple example. So almost all the people buy the insurance. Around say 4-5,000 is the premium which we pay to the insurance company, and in return we get around 20 to 30 lakhs of life cover. So if the person dies, the insurance company has to pay 20 to 30 lakhs depending upon the plan, and for that company charges a premium of say 5,000 per annum. Okay, so what happens now? You just analyze one thing: who is more rich, the people who are buying the insurance or the insurance company? And who has the more risk? Like insurance company is taking the risk of 20 to 30 lakhs for just earning 5,000 rupees as premium, right? And the normal people are buying the insurance to protect themselves. So there are two aspects: either you become buyer or you become seller. So insurance companies, despite taking so much risk, are very rich. Like, so in the options it works like same way. So option writers has a greater risk. It is in theory, definitely. So in practical also, if you sell the options without any strategies or without learning, you will burn your hands, definitely. So you have to learn. So go through this presentation. I hope you learn something today, and let's start this session. So first is, what are the benefits of options? Then why to trade the options at all? uh, why not to trade equity, or why not futures but to options? So first thing is better leverage. So you get very high leverage in options, and because when you buy the options you have to pay the very less premium. The amount of premium is very less, and if you sell the option, still it is very less compared to future. Okay, so it's a better leverage product, and it's like if you buy a lottery, you have to pay around say 100 to 500 rupees for lottery, but if you win the lottery you will get the jackpot around 10, 15, 20 lakhs, whatever, right? So you have a higher leverage, but if you lose, you lose only 100 to 500, the cost of the lottery. So that is the part of leverage. Now options can be used to hedge the portfolio. So when there is some events coming, or when you have a different opinion, so you can hedge your portfolio, like Brexit, or some event like elections, or some major event is coming, then you can hedge your portfolio through options. Then it's an effective risk management tool. Like if you are buying a future, you can sell the call. If you are selling the future, you can sell a put, and you can apply many strategies like covered call, covered put, butterfly, iron diagonal butterfly, strand, strangle, straddle. There are a lot of strategies to manage the risk through options. Now it's a regular source of income. Of course, the options have expiry date, so all the options which are for the current month will expire on the last Thursday. So you get a hell lot of money, and you can earn regular income through writing the options. Small capital requirement, of course. If you want to trade in the future, you have to pay a lot of margin, or if you want to buy the equity, then also you have to pay a lot of money. So with options you can start with say around 1 lakh capital, or say 50,000 capital, but for trading futures or equities you need around 5 to 10 lakhs capital. So you can start trading options with very small capital, of course with proper learning. And options are high income potential securities, not securities, derivative, of course. So you get very high income through options, like on expiry days the options or premiums, rather premium of the options may go to double, triple, 4 times, 5 times. We have students who have made around 20 times, 30 times. So it depends, but yeah, of course, if you buy, say, pay premium, say if you buy a call of Nifty with strike price of 10,000, and if the Nifty crosses 10,000 and reaches 10,000, say 200, so 200 is your profit. Now you might have given the premium of say 20, 30, 40 rupees, so it's around 5 times your investment. So it's a high income potential options. Now terms used in options. So what are the terminologies? A lot of people avoid trading options because they don't understand the options, because options has some terminologies which they might not understand, or if they understand, it is very complicated to understand. But don't worry, we will understand it very simple terms. Like first term is expiry date, then strike price, call, put, premium, intrinsic value. So you have to understand this, and time value. So you have to understand this terms to get the hang of it. So if you do not understand this, I recommend you to see this video 4-5 times, or you go to internet, or you buy some book on basics of options to understand this terms. So let it cover here. So expiry date. So what is expiry date? So book definition is expiry date is a future date by which the contracts have to be fulfilled, is called the derivatives expiry. So for say current month is say September, the last day of the September, or current month is say August, so last day of August, last Thursday of August will be the expiry date. Say Nifty August, last day is Thursday 31st August, so that is the expiry date, and all the options and future for the August month will expire on 31st August. Now strike price. What is strike price? Book definition: strike price is the predetermined price at which buyer or seller of the options are agree on a contract or exercise a valid and unexpired options. So what does it mean? Like exchange has standardized the strike price. For say for Nifty, the strike price are 9,800, 9,900, 10,000, 10,100, 10,200. So Nifty has a gap of 100 points, Nifty has a gap of 50 points, Bank Nifty has a gap of 100 points in strike price, Reliance may have 20 points, then Divi Slab have around 50 points, and lesser the price of the script or underlying, the smaller will be the gap of strike prices. Okay. Now what is call? So you need to understand this term like call and put very thoroughly to understand this options. Okay. So calls are the options that gives the right to buyer to buy some asset from the seller. So in simple terms, when you are bullish on the market, you buy call. Like if currently Nifty is say around 9,800, and if you are bullish that Nifty will cross 10,000, you can buy the call of 10,000 by just paying the premium of say 50 to 70 rupees or 100 rupees. So you can buy the call, and if Nifty crosses 10,000, you earn money. Okay, so that is a call. So you have a right to buy the Nifty. So don't worry about it. You just have to, if you are bullish, then buy a call. Say this Nifty August 10,100 call, you buy at 150. So if Nifty crosses 10,100, you earn the money. Okay, and as a option, an option to buy securities. Now put. What is put? Is a reverse. When you are bearish on the market, you buy put. But remember one thing: when you are bearish on the market, you have to have very clear view, and the movement should be very fast. So, like you may have the opinion that Nifty may cross 10,000, but if Nifty doesn't cross 10,000 in say August, but it crosses 10,000 in September or October, then you might lose your premium because your view was right, but it was not in timely manner. So whenever you buy the put or call, your view should be timely. Your view should be in time. Okay. So now Nifty in put, say Nifty 9,900 put, the premium is say 150. So if Nifty goes below 9,900, you earn the money. Now what is premium? So premium is the amount required to buy the option. So as I have told you that premium is the amount to buy the option, means I have given the example of the lottery ticket. So like if you have to pay 100 to 500 rupees for buying the lottery, and the jackpot amount say 5 lakh, 10 lakh, 15 lakh, whatever. So the amount of premium you have to pay to buy the options like call or put. And in premium there are two components, intrinsic value and time value. So we'll cover that in next slide. So just read this. Nifty August expiry 31st August. So strike price is 10,100. For call premium it is around 150 rupees, and for strike price 9,900. Put premium is around 150. So what is intrinsic value now? Please understand this very clearly. Intrinsic value is the amount by which an option is in the money. So now what is in the money? So there are three components. The option may be in the money, at the money, and out of the money. So at the money and out of the money options does not have any intrinsic value. Only and only in the money option has intrinsic value. And what is time value? So as I told you, there are two components. So in the money, at the money, and out of money. So out of money and at the money have only time value. So time value is the amount of premium over and above its intrinsic value. Okay, so at the money and out of the money option contract have only time value. So understand in this chart, see if current strike price, current spot prices of Nifty is say 10,000, this. So it is at the money. So intrinsic value is 0, time value is 155. So total value of the premium is 155, and it is at the money. So as you go up 10,100, intrinsic value is 0, time value is 95, total is 95. So it is out of the money. For 9,900, so it is in the money. So 100 rupees is intrinsic value, 130 is time value, and it is in the money. So understand it this way. So and reverse for the put, like if the Nifty currently is at 10,000, so for 9,900 strike price there will be no intrinsic value, premium would be, time value would be 95, and total premium will be 95, and it is out of the money contract. For 10,000 intrinsic value will be 0, time value will be 150, total value will be 150 premium value, and it is at the money. And for 10,100 intrinsic value will be 100, time value will be 130, so total premium is 230, and it is in the money. So what it suggests is, if the Nifty closes below 10,100 or at 10,000, so you will get the difference like 100 points, its intrinsic value, and this time value will be 0 on the expiry date. And remember, this thing very properly. Now options matrix. So as per most of the books, so whenever you buy a book or you go to any say online, or you may hear or you study, you will find this is very complicated to understand, that say right to buy, right to sell, obligation to sell, and obligation. I don't understand this, so I have made a simplified version for you, and that version is just wait, yeah, this. Okay, so this is simpler version. So whenever your view on the market is say bullish, this, whenever your view in the market is bullish, you buy call. Whenever your view on the market is bearish, buy put. Whenever your view on the market is not bullish, then sell the call. And whenever your opinion is, when the market is not bearish, you buy put. So people generally think that buying a call and selling a put is same, or buying a put or selling a call is same. No, this is not same at all. So now onwards, you have to form any one of these four view in the market, like whether the market is bullish, or whether the market is bearish, or market is not bullish. Like say if at 10,000 Nifty, so there is a major say resistance in Nifty, so you can identify that the Nifty is not bullish. So if Nifty is not bullish, and if you buy the put, you will not get any money, because at that time Nifty will be at around 10,000 only. So it won't go to 9,500 or 9,000, so you get money, right? So if it is not bullish, you have to sell call and not buy the put. If you buy the put, the premium will be zero and you will lose the money. Okay, and if the market is going down, or if the market is sideways, or if the share is not bearish, then you have to sell the puts. Don't worry, you will understand this, and how to form this opinion, like whether it is bullish, bearish, not bullish, not bearish. I will give you one tool so that you can identify this. Okay, so this is simplified version. Now the time decay. This is the most funny and most important slide, because if you understand just this thing, you will understand the options in a manner which I want to make you understand. Okay, what is time decay? So it is the decrease of an options premium's time value due to the passage of time. So if on today, say on 5th August or 10th August, I'm buying a call of Nifty 10,500, and I'm paying premium of say 100 rupees, and if Nifty does not cross 10,500, I will lose my money. So every day I will lose little money. Okay, so on 5th, say I have paid premium of 150. So if till 15th August, if Nifty does not cross 10,500, my premium will be say 100 rupees. And by 25th August, if Nifty does not cross 10,500, my premium will be say 40-50 rupees, say 30 rupees. And on expiry day on 31st August, if Nifty does not cross 10,500, my premium will be 0. So higher the time to cover the strike price, the higher the premium. Okay, so in the start of the month, the premium will always be high. In the middle of the month, premium will be almost half, and at the end of the month, out of the money premium will be almost 0, or say very little. So you have to be very careful when you buy the options. Okay, the rate of decay increases as the expiry date comes closer, definitely. So at start of the month, the market has more time to cover the distance. Like if I have bought 10,500 call, and the spot Nifty is 10,000, so Nifty has almost a month to cover 500 point. Okay, but at 15th August, the Nifty has just 15 days to cover 500 points. And on 25th August, Nifty has just 5 days to cover 500 points. So, as the expiry comes near, the time decay rate is increased. And this is most important. 90% of the options expire worthless. So, if the options are out of the money, they most probably they will expire at zero, worthless, and options seller will get all the premiums. So you have to be very careful. On expiry date, call and put has intrinsic value only. There is no time value, and there we have a strategy to trade on expiry day, which is called expiry special strategies. So we have almost 2 strategies to trade on expiry date, and people make hell lot of money on expiry date when there is a big move on expiry day. So on expiry day you have to be very careful, because there are a lot of chances of big move coming, like in Nifty, especially in Nifty and Bank Nifty. It's very difficult to get the premium. So we have formed a strategy to trade on expiry day and earn lot of money, like killing. So we have 2 things. By options writing you can run your house, and on expiry days by trading expiry strategies you can make killing. Okay, so one thing is make living and one thing is make a killing. In long options, time is against you. I've already covered this. And on short options, time is with you. So if you sell the 10,500 call, and if Nifty does not cross 10,500, all the premium is yours. And by day, the premium will be coming down and down and down, and you eventually it will go to zero. Now it's time to strategies. So here I am going to cover one strategy based on RSI.